Good afternoon, everyone. Today we are starting with our webinar. The topic of today's webinar is deep dive into actuarial valuations. Yeah, so on your screen you can see the agenda for the day. We will start with understanding the key actuarial assumptions. Then we will see how to set these assumptions. Then how reasonable these assumptions are, or how you can judge that are these assumptions reasonable. Following by the recent market trends in India, and then we will look into that how these assumptions are impacting your liability, and towards the end we will understand that how sensitive these liabilities are towards your how sensitive these assumptions are towards your liability. So moving on to the key actuarial assumptions. But before that, let's understand that what are the three most important components of an actuarial valuations. So do any actuarial valuations, the most basic three things that is required is data, benefit structures, and assumptions. Today we are capturing the third most important thing, that is the assumptions, and we are trying to understand it in more depth. Moving on to the next slide. So the key assumptions, I would say all the assumptions in an actuarial valuations can be bifurcated under two heads. The first one is financial assumptions. The second one is demographic assumptions. Under financial assumptions, we see the discount rate, the salary growth rate, and IND AS 19 or IAS 19 valuations. However, when we talk about US GAAP or AS 15 valuations, then there is third assumption, that is the expected rate of return, which usually in IND AS 19 or IAS 19 reports is the discount rate, the opening discount rate. And on the demographic assumption side, the assumptions usually comprises of mortality rates, attrition rate, normal retirement age, and leave utilization rate. We will be understanding all these topics in the coming slides. However, out here, I would like to mention that all these assumptions are usually finalized by the management of an organization. Your actuary can always advise you that what is the best assumptions that should be considered, but at the end of the day, it's the management's call that they need to take on what assumptions they need to finalize. But obviously your auditors can concur the assumptions, and then the final take needs to be taken by the management. Moving on to understanding what is discount rate. So discount rate is one of the most key assumptions in an actuarial valuation. Be it any kind of actuarial valuation, other long-term benefit, defined benefit, or any other actuarial valuation, discount rate becomes one of the most key assumptions. If I would talk about discount rate is used to calculate the net present value of the future liabilities, and how discount rate should be determined. So the paragraph 83 of Indian Accounting Standard clearly states that a discount rate that should be used for post-employment defined benefit plan, either funded or non-funded, must be determined with the reference to the market yields on government bonds at the end of the reporting period. So currently we are doing the valuation as of 31st March 2025. So whatever is the bond yield rates, government bond yield rates, that should be used to calculate the discount rate. The standard also mentioned that the currency and term of corporate or government bonds must be aligned with the currency and estimated term of obligation. So a lot of the time, a lot of the clients face this issue that why we are not considering 10 years government bond, which is the generally used government bonds, because the standard clearly states out here that the estimated term of post employment obligation should be used to calculate the discount rate also. So whatever is the estimated term of obligation of your particular organization, that is usually used to calculate the discount rate. What is the significance of discount rate? As I just mentioned, discount rate is a key actuarial assumption, and that affects almost all the actuarial valuations. It reflects the time value of money, but not the actuarial investment or credit risk. Fine. Below here, you can see some references for the bond yield rates. We usually use investing.com at our organization, but yeah, we can also use FBIL or Trading Economics to validate the discount rate. And usually, we see that the discount rates in all these three websites are very similar to each other. Moving on to the next slide. Salary growth rate. So the salary growth rate in an organization is usually given on an annual basis. Some of the organization gives it twice a year, depending on that how the structure is dependent on that organization. But as far as the general trend is concerned, salary growth rate should actually comprises of three components. The first one comes the inflation component, the second one comes the productivity component, and the third one comes the merit component. So what is the inflation component? So basically, every year on year, we see that there is a general increase in the price range of any market, of any economy. So just to take care of that, whenever we are giving an salary increment, we should keep in mind that the salary increment should at least cover the inflation component in an economy. If you are giving a salary increment lesser than the inflation component, it might actually result in a lower salary growth rate or a negative salary for the employees as compared to the previous year. So whenever you are determining the salary growth rate, please keep in mind that it should at least meet the inflation component of an economy. Moving on to the second part, which is a productivity component. So the productivity component of a salary growth rate reflects labor share in company or industry productivity gains. So usually whenever we see that there is a new organization or a new industry, the growth of that industry or that organization is quite high. But with a passage of time, as the company grows and the company becomes really stable, the growth attains a plateau, I would say. So in the initial few years, we see an exponential growth, which at a later point of time becomes a plateau. So depending on what stage the company or the industry in which the company is, we should also keep in mind at that particular component, and we should try to reflect that particular component into our salary. Moving on to the third part, the third one is the merit increase. Other than the industry standard or the company growth, there is certain growth or learning curve of the employees too. So yeah, it is very important that we should keep in mind that because my employee has learned during the past 1 year, we should also benefit the employees with the particular salary growth rate out there. So yeah, whenever we would be deciding a salary growth rate, we should keep in mind three particular points. The first one is the inflation component. The second one is how the company is growing, how the industry is growing, and the third one is how the employee is growing. So keeping in mind all these 3 points, we should decide what is the ideal salary growth rate in an organization. Moving on to the third assumption, which is the expected rate of return. So as I just mentioned, expected rate of return is a concept in AS 15 and US GAAP, which can differ from the discount rate, the opening discount rate. However, in India's 19 and IAS 19, the opening discount rate is the expected rate of return. So a lot of the people might ask, what is expected rate of return? Actually, the expected rate of return is the expected amount that I am expecting to earn within the next 1 year, depending on my fair value of plan assets. So whatever is my fair value of plan assets at the starting of my reporting period, how much return I am expecting out of it within the next 12 months. That becomes my expected rate of return. The amount that is expected out here goes to your P&L, and any amount that has actually been earned, if it is more than that or lesser than that, that goes through your OCI component in your India's IAS 19 reports, even in your US GAAP reports. However, in AS 15, since there is no component of OCI or income statement, the entire amount goes through your P&L. Moving to the next slide. Mortality rate. Yeah. So mortality rate is actually the probability that a person might die within service. So India's 19 mandates the use of best mortality rate for plan members both during and after employment. So when I talk about gratuity or leave valuation, such kind of benefits does not have a significant impact. Because of mortality, we see no significant impact on gratuity or leave valuations. But when it comes to pension or other annuity based kind of schemes out there, maybe mortality assumptions have a significant impact. A lot of the times what we see is that a lot of the company, since it's not significant, assumes a simple 100% mortality assumption of a particular table, maybe a ILM table or something like that. But it becomes very crucial to understand that what is our audience, what is our employee strength, and how my employee are designed, and according to that we should consider the appropriate mortality table. So for example, if I'm doing a valuation for gratuity of a person who is a desk job employee, so out there the mortality would be very similar to a Indian assured like mortality table, and hence we can take a 100% mortality out there. But sometimes we see that there are companies who are getting the valuation done for a coal mining organization or something like that. Out there the mortality would be certainly higher than what a desk job employee is. So if you are doing valuation for such kind of an organization, we should keep in mind that yeah, we can assume a higher mortality as compared to what the 100 usual assured like mortality table gives us. So as the standard clearly states that the best estimate of mortality for plan members should be judged out there. So these are few of the judgments that we need to keep in mind while deciding that what is the ideal mortality rate that we should consider for our valuation. Moving on to the next assumption, which is the attrition rate. So attrition rate, we also call as the withdrawal rate or the turnover rate, means the percentage of employees who have left the organization during the valuation period. Usually, the valuation period is annually. So, a very high attrition in an organization usually means maybe the organization is not up to the mark. Maybe the morale of the employees are low. Maybe it has a poor engagement, or maybe the industry is such that the attrition is quite high. So, a lot of the times, high attrition does not always mean that it's a poor engagement or low morale. Sometimes it's just the industry that we see in which the attrition is quite high. But yes, attrition is not good for any of the organization, as it's a very huge cost to hire a new employee. So all the organization try their best to reduce their attrition rate. But sometimes it's the industry that plays a major role rather than the organization. So it's very important to understand that what is the industry you are in, and other than that, you should try your best to reduce the attrition rate so that it's better for you, better for your organization, and also better for your liabilities. If I talk about the industries, we see if it's a security industry or a hospitality industry, the attrition rates are usually high. Whereas in IT sector, we see a moderate kind of an attrition rate, and in manufacturing industries, we see an attrition rate in the bracket of hardly 2 to 3% per annum. Moving on to the next assumption, that is the normal retirement age. So the normal retirement age is the usual age at which an organization plans on retiring its employees, or the employees plan on taking a retirement and chilling at their place. So usually we see that the normal retirement age varies between countries to countries and also companies to companies. The usual range of attrition rate or the normal retirement age varies between 55 to 65 years. The most common normal retirement age that we see in a lot of the companies is 58 years, followed by 60 or 65 years. And but again, sometimes we see that there are a lot of senior employees who are over the retirement age also. So yeah, sometimes a very large employee, a very senior employee can work in the organization even after the normal retirement age. But in such cases, there are certain different kind of agreements that they go into with the organization, and according to that, they prepare all these documents. A lot of the time, we see that the benefits, maybe the gratuity, the pension, the leave benefits, are not given to these employees. That completely depends at how these organizations are getting into this agreement with their employees. And these employees are usually in a very senior or top level management employees. So yeah, thinking of all these particular employees on a case to case basis is what is advised out while calculating the normal retirement age. Moving on to the next assumption, which is the leave utilization rate. So, if you have leaves left with you into your account, you can either utilize those leaves in the form of availment, or you can encash those leaves maybe during service if your policy is allowing it for. Otherwise, you can encash those leaves when you are leaving the organization. So the leave availment rate represents the percentage of eligible leaves utilized by the employees within a given period of time, typically measured annually for availments. In actuarial valuation, since the LIFO method is applied, the rate is determined based on leaves availed from opening leave balances. Okay. Similarly, leave encashment rate. So the leave encashment rate represent the percentage of eligible leaves that the employee is encashing within a given period of time. This is also measured annually. Again, out here, since LIFO basis is used for a natural valuation, leave encashment are always calculated on the opening leave balance. Uh, we do so to calculate a more accurate actuarial liability, because whenever we are doing a natural valuation, all the leaves that are there into the account of an employee can be utilized even before the employee is resigning the organization.